Welcome to this week's Financial Market Report by Quiver Financial. I'm Colby McFadden, and it's March 14th. And in the last 10 days, the Trump bump has turned into the Trump slump in the stock market as the equity markets have slid down, with the S&P 500 dropping almost 10%, the NASDAQ near 15%, and some of the Mag 7 stocks as much as 20% or more. And we won't even talk about what's happened in the Tesla stock or NVIDIA. What we're going to talk about this week is how we made money. How is it possible that we can make money in a week where the market slid as much as they can? I'm going to give you the game plan of what's happened. So this is a very special episode because normally what we do is, for anybody who's new to the show, our typical topic matter is to talk about the five things that really the five things that matter to your net worth. And it's things like interest rates, because interest rates control the price of all kinds of markets, from real estate to stocks to so on. I won't get into it. Real estate's a big part of your net worth. Stock market, of course, commodities like gold, silver, oil. And then the one thing a lot of people forget to ever think about is currencies, because currency trends across the globe can really affect liquidity. And we're going to talk about that in a second. I'm going to deviate this week like I did last week, because really we don't need to talk about interest rates. We don't need to talk about commodities. We really don't need to talk about currencies or real estate this week, because everything we talked about in our very first March report, called Singing with the Stones, is a ditto. Like everything we talked about then is happening now. So today, what I really want to focus on is on the equity markets, because it's got everybody's attention, and everybody's wondering, is this a run-of-the-mill correction? Should I be buying this opportunity? Or, holy shit, is this the end of the world? Now, really, folks, not a lot has happened yet. However, if you entered into the market too late, or you're too aggressive at too late of a time, you are feeling the pain now. So today, what I'm going to do is I'm going to give you the red zone playbook. What is the red zone? Well, the red zone is basically what you need to know if you want to get a girlfriend that's 23 years old and you're 70. Oh, wait. Oh, sorry, guys. Wrong show. You're going to have to check in next week for that show, because really what this is about is how to have the best risk and reward over a 3-year period if you're an investor. So if you're somebody who's 55 plus, really today's show is for you, because I'm going to give you the playbook of how you can operate a portfolio and make money in a down market. Okay, it's not about timing the market. Today's not about giving you investment advice. What I'm going to do is I'm going to break down for you what we did this week for our clients, and more importantly, what we've been doing for our clients over the last few weeks that allowed us to end this week with our head high, our chest out, and feeling like we can take on next week and search for some great opportunities in the midst of a nasty equity market sell-off. All right, so what's happened since January? So why are we talking about this? Well, the S&P 500 has gone down 10%, the NASDAQ down 12%, and the big leading stocks like NVIDIA and poor Elon with Tesla, NVIDIA down 20%, Tesla down 45%. Now, in real terms, these are not huge numbers, folks. However, if you were following momentum, if last year you were feeling like, oh boy, I'm not making enough money, and you leveraged up or you got too aggressive too late, boy, are you feeling the pain right now. However, I will tell you, I'm going to show you how you can work your way out of this. The Mag 7 stocks, the ones that have been leading everybody for a while, they're down 12%. That's things like Amazon's down 21, Microsoft down 17, Google down 21, Apple down about 13. So all the stocks only go up crowd just learned that when momentum changes, it gets ugly fast. We've seen this before, and I'm going to show you how you can use both strategy and tactics to avoid from getting in front of a freight train like this. And we've done a really good job of avoiding the yikes of markets over this past year. So what saved our bacon? How can I sit here on March 14th and say, hey, in this past week, when most everybody else saw their accounts go backwards, that us and our Quiver clients got to see our accounts go forwards? Well, I will tell you the one thing is metals. We've been talking about this for a while. Gold, silver, and now the miners related to the metals have really been rocking. While the stocks have been selling off, the metals have been running. Everybody who was a Bitcoin lover, sorry guys, Grandpa's gold still beating your pants this year. So here we go, right? Energy, even though energy has been one of those sideways moving sectors, it's now become that value play. So when the market sold off this week, you really didn't see much of a sell off in energy. In fact, you've seen the energy sector in certain stocks like Chevron hold together quite well. And then I'll show you a couple of charts on that. The utility sector, something we talked about 2 weeks ago as something that was holding together well on down days. Utility sector continues to hold together. I'm going to show you a couple of specific utility stocks that are in our portfolio that really went against the tide this week. And then that traded REIT, the traded REIT and mortgage REIT sector that we've been talking about, because interest rates have been right in the range we need them to, these actually held together quite well this week and paid some dividends. So diversification is really what saved our bacon this week. And it wasn't just diversification, it was what I would call quivercation. So here's what I'm going to show you here's what's saved us this week in a visual sense. On the top left is gold. You can see over the last week since our last video, it's continued to power higher. The top right is silver. It's continued to move higher this week, coming into resistance. So everybody who's watching these things, I'm not telling you to run out there and buy these. If you're thinking of getting involved in metals, make sure and reach out to us first so we can do some risk analysis, because things have been moving quite quickly for a while. On the bottom left here is GDX. That's the gold miners continuing to have a nice trend. And what will probably, this is what I'm watching here in the metals, is if you're somebody who feels like you've missed some of the move in metals, maybe keep with the silver miners. Now, they're horrible businesses, people. You are not buying these because fundamentally they're great stocks. This is a trade, because if gold and silver and gold miners have already moved, there's a pretty fair chance that if they continue to go higher, that the silver miners, the bottom right there, that the silver miners are going to play some catch up. So if you feel like you've missed it and you really can handle the risk, that might be an area that you pay attention to. But this was one of the main areas that saved our bacon this week as the market sold off. Utilities, here, look, XLU is a utility exchange traded fund, held together quite well this week. And Duke Energy, something we have in the portfolio, not only held together this week, made forward progress. Here's two things that pay pretty decent dividends of around 3% or higher. So, traded REITs, we've talked about that over the last couple of things, like EPR on the left and Annaly Mortgage REIT on the right. Even though EPR sold off this week compared to where we entered in, it's performed much better relative to the Mag 7. And Annaly, as you can see, has pretty much had a sideways week as the market has sold off. So energy and defense, you can see here, energy or Chevron as a proxy for energy, now trading above its 200-day moving average. I'd like to see it get some momentum. It really needs to get above 160. If it does, then you might have an opportunity of some trendy move there. So I'd keep that. If you're a dividend payer and you're a believer in energy, I'd keep Chevron on my radar for sure. And then on the right here is ITA, which is the aerospace index, or not an index. It's the aerospace and defense fund. It's a iShares ETF. There again, not a recommendation. It's just something to watch for that sector because it's bounced off its 200-day moving average, similar to like the utility sector. And the trend, the longer term trend, still looks intact. So there's quite a few areas within the market that look pretty darn good, even within this big sell-off. So that's what saved our bacon. Things like that weren't on people's radars over the last few weeks. So it's both diversification and correlation. So now I'm going to just get into the details of why I say this is the quivercation that saved us, because in most portfolio management, the focus is on diversification as a way to manage risk, which is fine. However, if you got 20 investments and they're all going up at the same time and down with the same time, so if they're all correlated to the stock market, and I've seen that in many portfolios where you could have 20 different mutual funds, or I see this in 401ks where all these mutual funds are moving in tandem higher or lower. Well, why do you need 10 different things going in the same direction? So it's really important to not only just have diversification, but to focus on correlation, which is where, when you combine them together, is what we call the quivercation, right? See where I'm going here, folks? Because at the end of the day, to have a really solid diversification that avoids things from moving in tandem up and down, you've got to pay attention to the 5 markets that matter. And those are the things like interest rates, real estate, stocks, commodities, currencies. Because at the end of the day, these are the dogs in the pound that make your money go up or down. Right. So if we can get the cycles of these marketplaces in a system to where we know how to wiggle within those market cycles, then your diversification can not only have risk management, but it can also avoid the correlation trap of everything moving up and down, and you have this like fake diversification. So that's really what saved us this week, is this process that we've been diligent about, of making sure that we're not just diversified, but making sure that the holdings that we have aren't correlated in their movements. So strategy and tactics is the other thing that really worked for us this week. Now, strategy is really your thought over the macro or the big term, long-term fundamentals. That's the decision. Are you in a bull market? Are you in a bear market? Are interest rates trending higher, lower, sideways? What's going on in currencies, like what they call the yen carry trade? Those types of analysis, more fundamental analysis, helps you create a strategy of, hey, should I be high risk? Like if you're looking at risk on a scale of 1 to 10, strategy is the part of that decision is, should I be a 10 all in the stock market, or should I be a 5, 50-50, or should I be a 1 out of the market? Well, that's part of strategy. And then tactics is where you're looking more short term to make sure that over the next 1 to 3 to 5 years, that you're seeing progress moving forward. So you're setting shorter term goals and creating a weekly or monthly or daily, whatever your goals are, maintenance to fit within those timeframes. And when you combine these things, diversification, lacking correlation, along with strategy, long-term strategy, and shorter-term tactics, that allows you to say to yourself, I don't worry about timing the market. What I'm doing is I'm timing the risks of the market, and I'm trying to leverage the risks into my favor. When things are too risky, like the stock market we identified in January as being too risky, you reduce your exposure to it and you diversify into other things like REITs and utilities and metals and things of that nature. So essentially, that's how we made money this week, is just the quivercation process, allowing us to diversify out into some of those other sectors, made a really, really big difference. Now, if you'd like to have more insight on what's going on in gold, what's going on in interest rates, then I'd encourage you to go back and look at our last 2 weeks ago, our Singing with the Stones report, because that'll give you more insight on some of those other 5 market factors that we track. We'll get back into that conversation very soon. But next week, what I want to talk about next week is this a buying opportunity or a bear market? And I'm going to show you what to watch for in April. There's the next move, the next bounce in equity markets is going to tell us whether this was a great buying opportunity or the beginning of a bear market. So stay tuned. Make sure and watch next week's show because it's going to be really, really valuable to you, especially if you want to be an equity investor in the future. And until then, folks, take care. Have a great St. Patty's Day. That's right around the corner. If this was helpful to you, please subscribe, give us a little like. And until next week, take care. Have fun. Bye-bye.